Great. So as I was saying, this is our last session of the day. It's been just an amazing event. We thought it would be good to close with a panel comprised of both those that supply alternative data as well as those that consume alternative data. And we're very lucky to have a representative from WorldQuant as well as Deutsche Bank on the consumer side, and two leaders from some top alternative data companies. The panel is called Disrupting Finance, the Impact of Alternative Data in Finance. And it borrows from our titles conference in that we were looking to discuss what exactly is going on in this industry. And more importantly, what are some of the challenges, what are some of the issues that we need to be concerned about? And our group today is probably the most qualified to talk about those. I started off the event with a few slides that brought up just a few of these issues as well as some of these opportunities, but I really hope that this panel will allow us to dig deep into these issues. I also hope to make it interactive, so we'll try to get our panelists to give us a sense of their views and just get some thoughts, and then we'll open it up for the audience to ask questions throughout the panel. I will let our panelists introduce themselves, and please take a minute and tell us a little bit about what you do and your interest in alternative data. We start with Yin.
All right, so I think most of you came to my first session today. So my name is Lowell. I run the global quant team at Deutsche Bank. We're primarily in the equity space, but we do cover all asset classes. We're a big fan of big data. I have to say we probably dealing with many big data vendors. We use big data for multiple purposes. The primary purpose is probably used to in the return forecasting context, so you call alpha generation. Hopefully we can use big data to improve our return prediction process. And I have to say that, as Armando mentioned, we have significant challenges of incorporating. So first of all, they're not free. You have to pay to subscribe the data. But that's actually only a small portion of what actually the real cost, which is managing, maintaining the databases, which tend to be far more expensive. Then the big question, of course, is do they really have alpha? Can you really scale it? Are they really providing something that different from what you already have? So I think there's a lot of challenges, but also opportunities.
Great, thanks.
My name is Matt Ober. I work for WorldQuant. I manage the data strategy. So we have a team across the world that's scouring for new data and new companies. WorldQuant's a multi-billion-dollar asset manager. We have offices in 19 countries. And our team is working with vendors around the world and constantly looking for new alpha generating data.
Hi, my name is Weinberg. I'm with ReturnPath. My colleague Anita Absi earlier spoke about us. We're focused on the email space where we capture an enormous amount of data. And one of our most recent initiatives for the past couple of years has been monetizing the mass amount of data that we're capturing from the inboxes of over 1.1 million US consumers, which is very deep in transactional activity, receipt data. We've worked extensively with a lot of research companies, a lot of hedge funds, and we're here really to help educate as much as possible this community as to the value of what we're seeing in the inbox and increasingly the shift towards electronic distribution of receipts and e-commerce as a really strong indicator of consumer preferences and hopefully equity activity.
My name is Leigh Drogen, founder and CEO of Estimize. We actually have our 5th year anniversary party coming up on Wednesday, so about 5 years old. We launched our data set in January of 12. Estimize is basically an open financial estimates platform. So what we do is, instead of your classic Thomson Reuters IBIS or Bloomberg sell-side analyst estimates, EPS and revenue, economic reports, we collect our data on our platform from about 25,000 buy-side analysts, PMs, traders, independent analysts, industry experts, students, academics, and it produces a widely more accurate and more representative, which is the more important part, sample of estimates, wider distribution, dispersion, larger numbers, And then we actually sell our data to large quantitative hedge funds. Matt's group at WorldQuant was actually our first client. They're also an investor in the company. And I got to thank Yin for writing a great paper on our data back in mid-14, which has gathered us a whole bunch of other clients.
Great. So if you permit me, I'll take a seat with you guys and get the discussion going. I thought it would be good to start with the challenges, right? So what are some of the challenges that you see in incorporating unstructured data sources in the investment process? Perhaps we can start with Yin.
All right, I think there are a couple of big challenges. I think a couple of speakers that they mentioned, I think one is history, right? So as quant, we want history, again, ideal as long as possible. But most of these unconventional data sources will have about 3 or 5 years of data. Some of them probably be even shorter. Two is about coverage. Again, sort of you want your sample size to be as big as possible. But again, many of them only cover a small portion. And most of the big data vendors tend to be very US-centric. So if you're looking for companies outside of the US, coverage tend to be even more problematic. Right, so three is again about, not necessarily about, so for example, using satellite images as a classic example, I talked to many of you. It's not really about technology, it's really about locations, right? So I could have the satellite images for Walmart, I was trying to analyze Walmart, but where do I get the location data? Where do I know the retail stores, the warehouses? They're probably not necessarily trade secret. You can probably, if you go to walmart.com, you can probably put together most of the data, but it's not really in the user-friendly format. And then, of course, you also have the cost involved. So really, the cost can really justify for the alpha, which may or may not exist, you can produce from your investment process.
Now, Matt, what do you see as, from a firm like WorldQuant? What are the key things that you are exposed to that make it difficult to incorporate it into, let's say, an investment model?
I mean, I think everything that Yin just said is probably a lot of the checklists we have before we even start testing data. I think a lot of the data these days is not ready for systematic financial consumption, so there's no tickers or identifiers in the data. And so we end up doing a lot of the structuring and merging of multiple databases together, which is fine for historical backtesting. But to put it into a production trading environment and constantly being updating with all of corporate actions, it makes it a lot more difficult. I think that's where the exciting new data sets are. But a lot of vendors are trying to sell data that's not really ready for our easy consumption. And then there's the price point as well. So not only do we end up having to do all the work, but now we're also essentially creating the product for them. So it becomes a challenge on where do we steer our efforts, because even if we're looking at 1,000 data sets a year and buying hundreds of these, we also have to decide what is going to give us the most upside in the long run.
Now, if we go back to one of the original questions I posed, does alternative data actually add value? And perhaps I should ask our providers of alternative data, maybe Eric.
Yes. Next question.
So tell us why. Come on.
We feel it does because we're seeing it in the marketplace. We've been out with our data set for 18 months now. We generally sign 12-month contracts, so we're now through the renewal cycle for our first batch of clients. Our renewal rates have been 100%, plus people are extending for longer periods. I think the biggest challenge, though, is, again, it's that education process with alternative data, not just in terms of the efficacy of the data, but how did you get it? Is it privacy compliant? What is it about? And there's a big time commitment from our clients to use and deploy the data. So it's an extensive learning cycle. And for us, it's just being patient and hopefully getting some clients who are willing to take that first chance and give it a shot.
Leigh?
So I think the last speaker actually said it really well. There's basically two different things that you need to look at. There's, do you have an information advantage, or do you look at the world in a different way? Are you analyzing all of the information available in a different way? And when I look at data sets like ours at Estimize, which is it's basically the same data set everybody's been using for earnings revision strategies forever. I mean, I was one of these guys between 2006 and 2010 who was running a classic earnings momentum, analyst estimate revision, stat arb strategy very successfully, especially through the crash. But that data's been around forever, and we're just basically selling data that's the same exact structure. It just happens to be more comprehensive and all these things. So we provide both an informational advantage, but a lot of our discretionary clients are also simply looking at the world in a bit of a different way. And what we like to say to them when they come to us, and some of them do say this, well, why are we paying you $10,000, $15,000 a month if eventually the alpha will get arbed out because that informational advantage will no longer exist? And we sit there and say, do people still pay for IBIS? And the reason people pay for IBIS and all of these underlying data sets is because there are, what I like to say, there are underlying kind of characteristics of the market and what is correlated to price, and there are emergent properties of what is correlated to price. Any unique data set over time goes through a cycle of being kind of an emergent property and having some reflexivity to the market and being able to generate alpha, which is still where we are. A lot of alpha in that data set because it hasn't been arbed. But you look at data sets like IBIS, which have been arbed for the last 20, 30 years, and it becomes a fact that it's actually an underlying property of the market that earnings, revisions, expectations are highly correlated to returns. And if you don't have that data, you're at a disadvantage. And so I think a lot of these data sets go through that big cycle of that second hump is really where everybody wants to get. And no matter whether you're at the first hump or the second hump, unique data sets can be very powerful, whether they've been arbed out or not, because eventually everybody has to have them if there's reflexivity.
So it's become apparent that a lot of these unique data sets come with limited history, or they have limited coverage. How do you overcome some of these challenges? How do you manage to extract value, if there is some value in those short histories, in order to make it work for you as an investor?
I think one thing we did I thought was quite fun, maybe not directly answer your question, but I thought it's partial answer to the question is many clients ask, well, there's so many alternative data vendors out there, and it's very costly. We definitely don't have the resources, although I thought I have a big team, to actually integrating all this data and testing each one of them. So if I only make a choice to pick a couple of them, so it doesn't really matter which one I pick. So, and of course, as quant, one thing we can do free is simulation, right? So we say, we have dealt with so many vendors over the years. Let's just take a random sample of 5. So we just randomly picking 5 vendors. They have various coverage and histories. If you actually make randomly picking 5, actually, the history is actually not so bad. Maybe 10 years ago, you only had 1. But if you look at the past 3 years or 5 years, you probably have all of 5, at least most of them. The coverage is maybe one vendor cover 500 companies, the other cover 25,000. But if you merge them all together, again, coverage is not so bad anymore. But the most interesting part is once you put together the 5, so we plot the distribution of this, we call it big data factor. You look at the average, or if you look at the distribution of performance, actually turned out to be fairly attractive. And more importantly, this big data seems to be almost uncorrelated with most of the traditional factors we have in our factor library. If you combine with your traditional factors, that value added seems to be statistically significant most of the time if you plot the distribution. So again, that I think is probably not that important to cherry pick which 5 of the vendors, but as long as you have a few which is reasonably intuitive and they are sort of, again, the correlation, the chance of correlation to be very high is pretty small, as long as you don't pick the 5 all from the same categories.
I mean, I think for us, it matters on the frequency of the data as well. If it's an intraday data set, 2 years of history is something we'll look at and we feel comfortable with. I think it becomes difficult when the data is very expensive for a 2 year of history. But I think kind of what Yin said at the beginning, it's about depth and coverage and history, and then how often it updates. And I think vendors can start to work with WorldQuant, for example, and give us data at a lower price point if they're going to be offering multiple products, and over time it'll build and prices can become more expensive. I also think there's a lot of data that's very interesting maybe for more concentrated portfolios or the fundamental side where they're very good at predicting a few stocks, and they should be really pitched in that way and going after the large holders of those companies. Whereas on the quantitative space, we're looking at baskets of a few hundred companies. It's very hard for us to get excited about a paper about how it predicted just Chipotle's earnings. So that's what you read about a lot in the news.
Interesting. So I did promise to open it up for the audience throughout the panel. So if you have any questions, just raise your hands and someone will come over with a mic. But let me just start with one additional question. So we did talk about capacity in the early parts of the conference. What do you think is the capacity of these alternative data sets, and how do you go about determining its capacity?
Capacity as in
As
how many?
in how much can you run through these data sets? How much money can you invest based on a strategy powered by one of these data sets?
I don't know about putting it all in one, but I think you can bring in unlimited amounts of data. I think at this point it's about how quickly can you consume alternative data. It's not about is there enough out there or is how much money you can put behind it. Our belief is the more data we can consume, the more money we can manage, and the more alpha we can find. So I think the only thing really that's going through our head is how can we automate our consumption of data and testing so that we can, if we test 1,000 new data sets this year, how can we do 10,000 next year?
And how would you determine, or how do you go about determining the value of the data?
I think it's a lot based off of the strategy that the specific firm or the risk that you're looking at. But I think you can do, we're testing things like how correlated is it to what we already have in production and things we've already tested in the last few years. What's the price and what do we feel is the capacity for the number of different strategies we can make, the number of companies it covers, a lot of data sets may have multiple different offerings within the data, so you can slice and dice in different ways. A RavenPack is a large, deep data set, so you're not going to have just one strategy, right? You have all the different taggings can be used by our portfolio managers that are doing intraday strategies versus some that are doing lower turnover, focusing on different regions. So I think, for us, it's really about how quickly can we consume the data.
You can definitely test it quantitatively, again, more like an estimate. Right? So whether the data has alpha or not, that's a pretty standard quantitative backtesting. The capacity, again, you can estimate it based on a more realistic sort of a setup, as Matt mentioned about, depends on the frequency, depends on the coverage. If you do a simulation of like incorporating your short availability, your realistic market impact model, if you do a simulation with 100 million, 200 million, 1 billion, 20 billion. If you plot the chart of the AUM of strategy versus the alpha, which is more like a Sharpe ratio, normally, of course, is declining pattern. So you can estimate, and this is again, we understand all different investors trading in a different way, but it's sort of a one fairly naive way you can sort of say, well, if my Sharpe ratio target is really has to be as 5, if you plot a chart of if I put on 5 billion, then the Sharpe ratio goes down below that level. That's your capacity. Right? So there isn't like a hard and fast rule. What is capacity? If you say, as long as my IR is above 0, then I don't mind. And of course, your capacity can be very high.
I think one other thing to think about for us is with all of the new data that you're bringing in, it's a matter of can the vendors actually support delivering to a hedge fund in real time, and how often does that vendor's API or FTP or however they're delivering it go down, and how does that look over time? Because the more new alternative data vendors that you see coming out in the world, the more that you have to support that on your side as a trading firm, and I think that becomes a bigger and bigger headache, and it becomes a bigger and bigger issue, especially with the smaller shops that can't fully support a hedge fund emailing and calling starting at 5 in the morning when the data is missing.
Okay. Now, as data vendors, we face some pretty tough and competitive clients, right? And they're quite demanding, as I've seen. I'm sure Leigh can talk about this as well. But I'm curious, like how much does a data provider have to do, or how far do we have to go to prove that it's valuable for some of these clients?
So there's a couple of different things there. There's obviously a range of different expertise levels at funds, different levels of resources that they have. Matt's team, fortunately for him, has an almost unlimited number of resources to do a lot of things, but many quant funds don't. So every data provider, I think, has to decide how far down the rabbit hole they want to go. So you can either basically just hand over raw data that's not structured. You can hand over something that's structured into a format where people can actually use it. You can provide kind of indices or kind of derivative measures of something that could probably be used to generate alpha. you could actually do the research itself, which is where we go to, where we'll actually do alpha generating research. We have a good quant team internally, and then we'll hand over that research. Or you can go all the way down to building a factor model itself and then handing over the factor model, which some firms do as well. And I think each company has to pick how far down the rabbit hole they want to go. I'd say for many quant funds, handing over a factor model is something that makes life a lot easier in order to get them to buy the data. And then they may go and test the structured raw data afterwards with the understanding that they probably want to do their own research. On the other side, I think just getting them through the testing process is something that firms need to learn how to do, and it's not simple. You have to hold their hands all the way through, and if you do it haphazardly by literally just throwing data over the wall and saying, come back to us if you want to buy it, you will have a really hard time selling data. And that's something that I think every firm has to learn. And it goes down to having cheeky, how to buy process, papers. And what step are you in the process? Are you at data integration? Are you at general back testing? Are you at, does the alpha that you're seeing in our data correlate with any alphas, as Matt was talking about, that we already have? And understanding where they are at every point in that process is an absolute necessity to get to the end of the day, which is you want to sell them the data and you want them to make money so that you can jack the price up on them next year.
Okay.
So Eric, how far are you willing to go to sell your data?
I think reasonable, but I think that the key for us is the investment in the infrastructure, right? I think a lot of times that's not discussed as much, but the building up of the factory to ensure that you can get data out reliably and consistently, and that it's without errors is really critical, and it's really time consuming. And we do enjoy working with a lot of the hedge funds because they're among the most discerning of all of our clients. They have a very different approach to it, say, than research companies. For us, we're not in the research business. We don't have a team of people interpreting the data. Our view is to take the data which comes in, our receipt data, where the volume keeps growing by the minute, and put some structure behind it, and to take what is very unstructured, unwieldy data, and to get it out the door. And we also believe that a lot of the value coming from our data is not just in the raw data itself. We don't really consider it raw. It's actually pretty structured when it gets to the clients, but how our clients interpret the data. They've got pretty smart people around it. And one of the things which we feel is really beneficial is that we're not really worried about commoditizing what we offer because the interpretation that goes with it. Right? We cover, at a minimum, 600 key publicly traded retailers, or vendors for that matter. Everyone's going to be looking at different companies. Everyone's going to have a different take on the data. So we think there's really unlimited opportunities for people to look at what we're doing and make their own mark with it.
Great. So I remember more than, 10 years ago when we started selling alternative data. We thought that every fund in the world could use it. And over time, we learned that there were different levels of sophistication across funds. Honestly, I thought that there were 10,000, 20,000 funds that could use it. It started narrowing down to the hundreds. And then you started meeting firms that had such a technological edge over others that those were the ones that were adopting or early adopting some of these new data sets. Now, my question to the panel, how many funds are there today that can actually take advantage of alternative data?
It's probably growing, but it's not as massive as people might initially expect. I think the challenge, at least for all of us, is that there's been a proliferation in the amount of data that's out there and the sophistication of the data that's out there and the types of data that's out there. But companies' ability to interpret and to have the resources to put the time against it is still challenging, still taking time. But there's enough companies out there that can do it, and they just need to get resources over time, the other ones, to build up that competency.
I think it depends on what you determine to be alternative data. So thankfully, our data set is basically the same structure as a data set that's bought by almost everybody. So that makes it easier. I think the real, there are two real bottlenecks in the funnel towards funds adopting new data sets. The first is literally just, do they have somebody like Matt who goes out and finds them for them? Because there's a deluge of companies out there and a deluge of different data sets. Data exhaust is coming out of everything, and there's a lot of predictive value in a lot of it, but understanding what to go buy when you probably are getting bombarded by a million different companies every day is really tough. And I think that's an incredibly important role at firms at this point. We see more of them hiring those types of people that are out there, being the funnel, being that stop in the funnel. I think the next stop in the funnel is literally just doing research for research's sake. We talk about like basic scientific research leads towards commercialization of things down the road. I think the same thing happens at quant funds, but the problem is many quant funds don't just have quants laying around to do research for research's sake, so that hopefully later on they can do something with it. Quants have to manage their own book, and they have a strategy already. And so I think that's the other kind of kink in the funnel is firms like Yin. Yin's group is incredibly important to the ecosystem because they operate as that kind of function. And I think more firms need to invest a little bit more in that person who is literally just going to test new data sets, because there aren't too many firms out there who really have the resources to do that.
No, I think that's sort of, we probably talk to most of the large institutional managers globally. And I have to say it's a small minority of them who actually do have the resources to incorporating what you like to say is like an unconventional data source. And as Leigh mentioned, even for us, like we have a dedicated team just to manage onboarding new data sources, but it's still like there's so many of them. At any given point in time, we can only onboard 1 or 2 vendors. And the typical research cycle, again, we only doing research. We don't even manage assets, which is very time consuming. But even doing research, the typical cycle is at least 3 to 6 months. Right? You think about if you have 10 analysts, you can work with probably 20 new data sets a given year. And of course, analysts still have to spend the time to maintain the existing models and doing some other work like client requests. Right? So you can actually realistically, we'll probably only deal with probably 3 to vendors with new data sets per year. So that's sort of, again, a big challenge. You have to make a choice about what you actually want to study. You have to fit into the analyst, of course, his personal own interest, right? So maybe a great data sets, but if he doesn't feel sort of a fit into his personal interest, and it's kind of a big challenge. Right, so on our client side, again, is sort of the same challenges. Most of the client, of course, they manage assets, and managing this assets itself is like a big day-to-day work. Right, so incorporating data, I think, is definitely a huge challenge.
Yeah, and now when you think about all these sort of new data sets coming into the financial community, it would be great to get your vision, like your thoughts on where do you think the investment world is headed with all this unique data? Is it going to become more efficient? Is it not? Is it becoming more competitive, more secretive, more open? What are your thoughts? Maybe Eric, start it off.
That's a tougher question for us because we're not as close to that. I think, I think that the trend is going to be towards more data out there. Companies are going to have to beef up in this area. And again, I think that there's a lot of value in the data itself, but the interpretation of it is going to be critical. So I don't think there's a simple answer to that question. But I still think that we're at the early stages of this whole thing, and that's really the critical thing, right? It's really just new, and people have to begin to accept it. And I think the more that they begin to accept it, they'll continue to put more resources against it, and what's seen as alternative will be seen as mainstream, and that will help all of us with the acceptance of these new data sources.
It's definitely an arms race. Look at what's going on in quant returns. I believe it might have been Yin's group that wrote the paper on the average returns per year of the different stat arb strategies, and they don't look too good recently. And I think that's because a couple of really big firms that are very sophisticated and are out there buying new data sources and having new factors are eating the alpha. The quant space has kind of been deluged with entries of different firms over the last 10 years, and it's too crowded now. And so it's definitely an arms race. And I think the firms outside of the top, let's call it 10, are just learning how to staff up their armies for that arms race. It wasn't an inherent thing that they understood how to do, and some of them are scaling incredibly quickly, and we see some of them kind of, they don't really know how to do much besides their classic index arb strategy, which works well at some level, but when it all goes bad, they all go bad together.
I think one of the future, I think, is maybe for the vendors is what depends on the data set, but some of them are awfully large data set. I think that the vendor can put it on the cloud. We deal with a few vendors, which we thought was quite interesting, that will off the burden that we don't have to load all this massive data, which working for a big bank, storing data is still very expensive, unlike working for a small hedge fund, you can use Amazon Cloud. So for us, as data storage maintenance, we're getting a big invoice from our technology department every year. So if we can process the data on the cloud using the vendor's own cloud, then we can take whatever the factors we computed, then put it into our system, then do the backcasting. I think it's sort of a huge cost saving. So that's like one small dimension. But we do find more and more vendors are moving into this either public or private cloud. The speed of computing and again, the cost of computing is getting cheaper every day, but it's still quite expensive. Right, so this is kind of another future, I think, is with the cost of computing getting cheaper and cheaper. Nowadays, when we're getting onboarding a new data set, almost like regardless, before we started doing anything, we would just throw potentially every single variable into a random forest algorithm, and then we get the list of the most important variables. Then we're starting to do our own work. Right, so this is sort of maybe 10 years ago, that itself can be very expensive. Now it's not expensive anymore. But still, using random forest in a production environment is still very slow. But for backcasting or for research purpose, become readily available these days.
Matt, you're a big consumer of big data, right? Where is most of the innovation coming from?
I think it's coming from a lot of the new up-and-coming companies, like not so much from your big financial vendors that we're all used to working with. I think, with all the technology changes in Amazon Cloud, companies can create new opportunities, new products pretty easily. So we see a lot of, startups that are 2-3 guys, and they've created some pretty interesting things. I also think that there's a whole host of companies that never sold into the financial space that have been collecting data, whether they do marketing analytics or they have a website that does commerce that now has all of this data, and they have 4 or 5 years, and they're very interested in monetizing a data business. So I think that's providing tremendous opportunity.
Any more thoughts on where it's coming from? So when you think about this evolution of new data sets, where do you think we're going with this? If you had to predict in the next 10 years, where do you see the alternative data space being? And what are the types of data that you think are going to be the most influential in finance? Maybe Leigh, start off.
Yeah, look, I'm obviously biased, but I think the social aspect of the internet gives us the potential to replace many of the historical data sets that were poll-based things, whether they were via email or mail order or whatever, that were of a very small sample set of a very specific type of people from a biographical background. Many of those data sets obviously produced by the sell-side research analysts at brokerages. And I think that the web gives us the ability to collect data from the crowd across many, many, many different data sets. We've got 3 of them going now, but God knows I've got 15 other ideas that I'd love to see other people execute on. And I've given them out to other people, and I hope that they run with them. And I think that that'll eventually, they'll turn into massive businesses. And largely because when you look at the crowdsourced businesses that came out of the sell-side data, Thomson Reuters IBIS, a bunch of the Bloomberg data, FactSet data, CapIQ data, market data. What we find is that when you go outside of just the sell side, which has a Reg FD issue, where the banks have to hand over their data to several different platforms, if you collect it from a community that you build that's proprietary to you, the value of your company is obviously much greater because it can't be replicated elsewhere. And I think you're going to find a lot of different companies spring up to do this kind of work, to collect data from different types of crowds, different data in different asset classes. We patterned our company off of data explorers, which was basically a buy-side short interest data set that got bought by market. And the philosophy, the strategy, all of it is the same. And I think you're going to find dozens of different companies do similar things there.
I think for us, there's two areas of focus. One is we're in this period where, kind of what you said earlier, there's been a focus on panel data in lots of areas, and we want to get to a stage where it's more census, because it just allows for much more granularity. That's going to be a long journey, but technology is certainly moving in that direction. The other thing which we pay attention to, which is a little bit different, is just notions of privacy in the marketplace, what we're going to be allowed to do with people's information, how that's changing. Our view is that generally, as long as we're being privacy compliant, despite a lot of press out there, people are increasingly comfortable sharing information. That's, I think, a beneficial trend for us, and I think for alternative data sets in general.
Matt, your thoughts on the future?
I mean, I think it's very early stages. I think what Leigh touched on with what Estimize is doing, what Data Explorers did in the past, I think is very interesting. Data Explorers was something that was a give-get model for a long time. It was early and not a lot of people heard about it. But now, if you do any sort of long short, you have to have some sort of Data Explorers type product. There's a few others that are similar, but it's become like a staple for hedge funds. So you're going to see a lot of these new data sets get to that point where everybody has them. But I think thinking about how much venture capital is going into fintech and how fintech capital markets investments is starting to build up, I think that we're going to see a lot more companies continue to pop up, and it'll be exciting to see which ones start producing very interesting data sets, but also numerous products, and get away from just being very focused and actually offer something in comparison to like a FactSet or a Bloomberg.
I think the three vendors on the panel actually probably represent what I'd like to see, at least the near-term future. Right, so crowdsourcing, Estimize, we're a big fan of it. We think this is sort of one thing is you can crowdsource almost everything. In the old days, it would take millions of dollars, multiple years to develop, let's say, insurance fraud model. Nowadays, you can put a crowdsource almost any sort of models or modeling techniques. You think about emails and, let's say, textual data, video, audio, satellite images. I think all these sort of unconventional, traditional would be very difficult to process. We may have a certain algorithm to process, let's say, textual information, but the computing was too slow, storage was impossible, getting access to multiple channels were also very cumbersome. Now, the technology advances make all these probably potentially possible. So I think these sort of represent the future of big data, unconventional data sources.
Excellent. I know we have some people raising their hands for questions, so I have one.
I think a lot of interesting points were made by all you guys. I want to just touch upon what we use them, which is, look, if you look at earnings data like IBIS, I mean, that is a staple, and you mentioned that WorldQuant yourself. Excuse me. How do you guys think about the decay value of some of these alternative data sources? I mean, I don't view earnings data as alternative data, and form is kind of so fundamental to the investment process in many ways. But when you consider onboarding new sources of data, do you guys have an ability to think about it up front in terms of what is the decay value of the data over time? And amongst data sources that you're seeing, what are the things in the market you want to see in the future that you don't see today? I think that's sort of to your point. You've got a lot of ideas and you've sort of thrown that out, but where do you see this going in the next few years?
Well,
I'll talk about it really quickly from my perspective, and then I think Matt probably has a great perspective on it as well. Look, I want the alpha arbed out as fast as possible. I want the alpha arbed out as fast as possible because every unique data set where you can't get it anywhere else, once it becomes reflexive to the market, everybody has to have it. So I would rather sell data to 10,000 customers at $5,000 a month than 200 customers at $15,000 a month all day. So that's kind of the fund's job to figure out what happens at that turn. We're trying to get there as fast as possible, honestly.
I think for us, we track our data P&L by the day. So we're almost tracking our data sets like you would track a stock. So instead of all the traders on our execution desk looking at our positions, I'm looking at every data set and how it's trading over time. So we're constantly getting rid of things at the end of the year that we just, after a few years, it's just not doing anything for us anymore. But I think that's something that a lot of these startups have to start thinking about, is you can't have just one product. You have to have multiple things and continue to innovate. And I think for us, we'd like to see more, and Ian touched about this, more data that's not just covering US companies. It's easy to create these US focused companies, but focusing on Asia and China and Europe, where a lot of hedge funds actually have investments, it's difficult to find exciting data outside the US that's good quality and deep history. And I also think that ETF data is a very exciting space for a lot of people, but finding uncorrelated ETF data that's not just something that we have in the basic equity world is also a huge opportunity.
I think the speed of decay is not nearly as fast as you think. Right, so we wrote our first research on RavenPack data 2009, so 8 years now. The return we haven't really seen much of decay. I think most large clients getting our research for all these years hasn't been arbitraged away. We look at Estimize data a couple of years ago, still working well. We wrote the research on Data Explorer's short interest again 5 years ago. We did research on Revere. Actually, our friend AQR, Andre Fazzini, wrote a research on customer supply chain data multiple years ago. We tested using slightly different data source, so we use Revere. And the signal still works well. Actually works even better post the publications than the research was done multiple years ago. Right, so even when I'm sure Armando want everybody to subscribe to your data, but again, after we wrote our research multiple years ago, not everybody, I think, still a fairly small community adopted, let's say, for the news sentiment data, right? So it's not nearly as fast. From our conversation, I think the majority of our clients still think this is going to be interesting, but only a small percentage of them actually implement it.
It took over 20 years to ARB IBIS, and that's like the most widely used data set ever besides tick data. So.
Well, value momentum still works. I mean, published.
And it still, and it still works.
Do you have a question over here?
Yes, over here. Question I have is regarding, at this point in time, it seems that new data sets and new data ideas of what to do with the data sets seems to be arriving at really a rapid rate. At the same time, you've indicated that some data sets that were in fact the foundations of this business are beginning to drop away because they're not as unique, more people are offering them, and so forth. So first question is, are the data sets, new data sets, still arriving at the same rate as you were seeing it when the thing first exploded and took off? And even though there may be 15 ideas that you have now, they might be 150, how rapidly will it take to find out if any of them will provide at least enough to replace some of the data sets that have just gone away? And for that matter, as you find more and more data sets, as the whole industry matures, isn't there a risk that some of these will just be providing similar or the same kind of information as others that are already there? I mean, these are some of the things that would be keeping me up at night if this were my business.
Anybody want to take it?
I think that there's a ton of new data sets coming in every day. And I think it depends on the strategy, on how quickly you can determine if it's been valuable or not. For a company like ours, we bring in so much data, and the way our portfolio works, we give data sets a few years to see how they perform over time. As PMs get more comfortable, more weights put behind alphas that are based off different data sets. I think it's early stages in terms of how much data is coming in, and it'll be exciting to see 5 years from now what companies are still around. And I do agree that there's a lot of people doing the same thing, and there's a lot of companies. It's a race to the bottom in terms of price, and I think that's why they need to continue to innovate to have more than one product. Social media sentiment, it's exciting space, but if you're just focused on sentiment on Twitter, there's probably 200 companies doing that. So you have to have multiple offerings and make that product a little bit more open to other industries potentially.
Well, from a user perspective, we don't mind, right? So even if you look at the traditional company fundamentals, you still have like 4 or 5 and more vendors providing company fundamentals. If you look at economic data, you can source it from the Fed database almost free, but you still have multiple vendors providing even US CPI data. And there's still a benefit of using certain vendors. They all have different trade-offs, they have different coverage, they have different business models. Again, if you just look at your traditional company fundamentals, there is some vendors at complete point in time, some are not, some are better US, some better international, some have better history, some have better quality controls going forward. We want them to be diversifying. We don't want just have one vendor dominating one space. And generally speaking, in that case, we see the quality decay and the price, of course, goes up. So again, we don't mind. So as long as they competing with each other from a user perspective, that's more than welcome.
And I think that's a good point about the point-in-time data, especially for fundamental data. We have no problem having fundamental vendors all around the world that maybe have a better specialization in Korea versus a CompuStat that's going to cover everything, won't have that deep focus, and maybe doesn't have the deep point in time and capture things that how they should be captured in that region or for a specific industry. So for us, we are constantly looking at new fundamental data sets, even though that's considered, the basic data of the financial space.
No, that's a great point. So from like a Wayne, for example, providing fundamental data in China, both in local languages, but also translating in English, that's a huge advantage. We did compare, for example, with your traditional company fundamentals, right? So far better coverage, a lot more timely, and all that sort of things.
We have time for one last question. The back.
I wanted to know what's the role of an open source platform like Quantitative in this case?
Oh, interesting question. I'm not so I think they've done a great job. I think they've done a better job than anybody else. And God knows there have been a lot of them that have failed. I think it's hard for proprietary data sets to get their arms around data stores, largely because the process of selling data at a high price that's unique, that has alpha in it, is not just, hey, go grab the data out of Quandl and buy it if you want to. It just doesn't work. Reference data, yeah, I think Quandl's awesome for that. But it's hard to get that relationship right between the vendor and the client when there's an intermediary like Quandl involved. That said, I think for many data sets, they're going to have a great business, and it's a great platform for them. Yeah.
I think it's also a great place to find information. If you're a small fund and you don't have a team seeking new data, Quandl's looking at thousands of new startups and vendors around the world all the time. Going to Quandl just to find information is actually a good place to look. We're surprised sometimes things we see. The company doesn't have a website, but Quandl somehow has their data.
Excellent. Well, I would like to thank, first of all, our panelists for such a tremendous job. Thank you for sharing your insights. And we're about to finish now. I thought I'd just close up with a few remarks. I was surprised by the fact that the message today was about sharing data and networking and being open. When I started in this industry, I used to meet with a group of quants that were prohibited from asking questions. So it was only about us telling them what we had, and if someone asked a question, I remember the senior person in the room looking at them, glaring, and quants would just go. They were prohibited from asking questions, and now I think the industry is opening up a little more. I think it's actually making sense that we do talk about these things because there are so many problems that need to be solved, and buyers of data, providers of data, we need to work together to figure out what makes sense and how can we actually add value throughout this process. So it's quite exciting for us, especially in the alternative data space, to have this sort of close collaboration with our customers. Again, thank you all for coming today. Please stay for the cocktail reception just outside the door. Hope you guys can hang out for a while, and we hope to see you next year as well. Thank you.